Derek Keet, Remax Elite. We've got Phil Jungwirth with us again.
Hello.
And we're just cutting in. So the question, and something we just kind of popped in here, was just on alternative lending. So we want to talk about alternative lending and just kind of how that works. So it's for some people, you were saying as well, it's a scary thing. Like, oh, okay, what am I getting into? And you, I mean, obviously, when it's alternative lending, you can hear all kinds of like it could be through the roof and this and that and a lot of extra fees. And just talking with you, it sounds like it might be a reasonable option for some people. So we're going to get into that in a second. Like, subscribe, give us a thumbs up, show us some love. We talk about alternative lending a little bit more because I was actually just the other day, I had a buyer and I said, well, don't we have something else for him? Or what do we have for him? And he's kind of talking about like alternative lending, but then you look at like what sort of the interest rates go up by quite a bit and like what fees, and then your like minimum down payment and stuff gets a little bit complicated, right?
Yeah, so alternative lending can actually be a pretty good tool. I'm a good advocate of it because I've used it myself. Especially for business owners. So for business owners, alternative lending makes sense in most scenarios because as a business owner, you try and pay yourself less to avoid paying taxes. And as long as alternative lenders will look at that with a more common sense and be more like, okay, this person can actually pay themselves a lot more. They're just paying themselves this amount to not pay taxes, whereas the big five banks are going to be more sticky on that. So a lot of people that are business owners go with alternative lending because the fees that you pay, and we'll get into that, is going to be cheaper than paying your $30,000-$40,000 in taxes. So as far as alternative lending goes, the rates right now are actually kind of similar. Like a 2-year fixed with an alternative lender is going to be around that 7% mark, and a 2-year with a big 5 bank that is uninsured is going to be around 6.8, I would say 6.7. There is a 1% fee when you do get a mortgage with an alternative lender. They just charge it. It doesn't go to the broker, but they do charge a 1% fee, and that's a 1% of the mortgage amount that they charge. So there is that too. It's going to be whether you have if it's a $500,000 mortgage, it's going to be $5,000. But if you look at the $5,000 and the difference between the bank rate and the the alternative rate, people like to go to the alternative rate because I had a client that was able to afford something $200,000 more just because the alternative lender looked at it with a little bit more of a common sense mentality. But, yeah.
And I think like my feeling now is with the bank, maybe I'm generalizing, but I feel like with the bank, you've got someone there that's not actually making a decision. You've got an algorithm that's making a decision. You've got enter in the information, press enter, and then they see kind of what they're doing, right?
Yeah, a lot of the times banks are going to be your more cookie cutter aspects, and a lot of people, especially self-employed investors, don't quite fit that cookie cutter anymore because they pay themselves in a different way.
And they try to avoid tax, so they're not
Yeah.
trying to get a high notice of assessment, right? They're
Exactly,
trying to kind of lower that down.
Yes.
But then, like I was saying before, sometimes it's you were saying as well, is they're able to show that they're able to make these payments, right? So they're able to show that they would be able to make the higher payment. They could borrow a higher amount, whereas the bank doesn't really have a way to even look at that sometimes, right?
For sure. They definitely don't. I've worked in both the broker side and the bank, and there's a ton more programs out there for people like that. And like I said, there are lenders out there that will, if you have 40% down, they will lend on that property as long as, of course, there's going to be some stipulations, like as long as it's worth that value, it's in a populated area, it's not in the middle of nowhere. There's going to be some stuff like that, but they will lend on it because they know that they won't lose money if things go south. And of course, you have to show that you can kind of make the payments, or you can make the payments. They don't.
Of course, yeah.
They don't want to give.
I'm not going to give it to you, but
Yeah, exactly. They don't want you to give them 6 or 35% down and then you making $10 a month. That just doesn't make sense to them. They don't want that automatic bad thing to happen. But
And you were mentioning 1%. So you're saying, well, generally, this is general. Of course, every situation is going to be different. But I mean, so you were saying roughly if you're paying an extra percent on the mortgage percentage and then 1% fee.
You're looking at
what other fees are we looking at?
Yeah, so you're looking at a 1%, that we call it a lender fee on the alternative side. And plus I would say let's be generous and be 0.4 difference or 0.5 difference on the rate side.
Okay.
Now on a 2-year or 3-year rate, it's gonna be different from every size of mortgage, but we're probably looking at an additional, let's say $8,000, $7,000 over the 3-year life. But if you look at that additional $7,000 and let's say instead of paying yourself $120,000 a year, you're paying yourself $60,000, well, you're avoiding probably $30,000 in taxes there. So that $7,000 makes sense to do instead of adjusting your income so that you can get a mortgage with an A lender.
Right. Okay. Yeah, sounds good. Awesome. And if you have any other question, guys, on this, just ask and we'll get back to you for sure. All right. Thank you.